Hey, what's up, guys? How's it going? You have arrived at the weird part of YouTube where a guy in a Guns N' Roses t-shirt is going to talk to you about your money. If you want to get consistently higher returns than an index fund or a mutual fund can provide, investing in individual stocks may be the way to go. But how do you do this without throwing darts at the dartboard and hoping one of them sticks? Well, you need a good strategy. And Phil Town's book, Rule Number 1, may just provide the strategy that you need to earn a 15% return on your money every year. In the interest of transparency, I do not consider myself an expert stock picker, and I don't consider myself an expert investor. Again, I'm wearing a Guns N' Roses shirt, people. But I do intend to implement a portion of this into my portfolio. Getting into this book, it's very much so a value investing strategy. And if you're not familiar with what value investing is, it's basically just buying stock in excellent companies that are priced below what they're worth. So it's akin to buying stocks on sale. And Warren Buffett would be the most famous value investor. Basically, what Phil Town does with his book is take Warren Buffett's approach to investing and Benjamin Graham and kind of tweak it to kind of his own philosophy. The book does an excellent job of walking through the whole process in detail, starting with, finding what company you want to invest in, all the way up to buying the stock and all the kind of individual things that go into that, like opening a brokerage account. So I'm not going to go into full detail, but I'm going to summarize the book now. What the heck is rule number 1 anyway? Well, rule number 1 is to not lose money. And in order to not lose money, you need to understand the businesses that you're buying. And to do this, you do research and you make sure that the businesses that you buy meet what are called the 4 M's. So this is meaning, moat, management, and margin of safety. For the first step in this process, you're not too worried about margin of safety because this is something that you'll calculate later on. So we're really just focused on meaning, management, and moat for this first step in the process. So for the first M, meaning, the business must have meaning to you. If you were the sole owner of this company, would you be proud to own it? Do you believe in what the business is doing? So for the second M, moat. The business must have a moat, which means it needs to have some sort of competitive advantage to keep them in business for the long haul. So 2 examples used in the book are Coca-Cola with their secret recipe and Harley-Davidson with their long heritage and brand recognition. The third M is management. A company must have strong management in order to be a rule number 1 company. So Elon Musk, Jeff Bezos, Steve Jobs all come to mind as being real strong managers of a company and really taking companies to the next level as opposed to just cruising and eventually kind of dying. The fourth M is margin of safety. And like I mentioned, we're going to worry about this later on after we've chosen a company that we want to invest in. But this is where you make your money, right? If you're wrong about how much the business is actually worth, this margin of safety is going to allow you to not lose money. And because rule number 1 investing is all about not losing money, the margin of safety that you're going to use with this method is 50%. So if you believe a company is worth $100 a share, you're not going to buy it unless it's selling for $50 a share. If the first 3 M's are satisfied, then you're going to move on to calculate the big 5 numbers. And the purpose of this is to see how strong a company has been ideally over the last 10 years, how much it's grown, and to really see if it's a company worth investing in. For all of these metrics, we want to see at least a 10% growth rate each year over the last 10 years. So for the first metric, it's going to be ROIC, which is return on invested capital. This is a favored metric for value investors because it shows how good of a job a company has done investing in itself year over year. The higher the ROIC, the better a company is at investing in, themselves. The next 4 metrics are growth rates. These are sales growth, earnings per share growth, equity growth, and cash growth. If all of these growth rates have been consistent over the past 10 years, this gives us a much better idea and it makes it much easier to predict how they'll perform over the next 10 years. Now, obviously, nothing is guaranteed, and the older companies get and the bigger they get, the harder it is for them to maintain prior growth rates. But if a company has been consistent, it makes it a heck of a lot easier and gives us a lot more confidence in our projections than if they're all over the place. If a company has 10% 10% growth rate, sales rate, equity, earnings per share growth consistently over 10 years, that's going to be you're going to be a lot more confident in your projections than if it's 10%, 200%, negative 15%, 4%, 50%. It's, all over the place, does not inspire confidence. I'm not going to go into detail explaining each one of these growth rates because honestly, it would be boring and it would take too much time. But Investopedia is an excellent resource to learn more about them, and I'll link that down below. If the business meets the big 5 metrics, then what you're going to do is calculate the sticker price. The sticker price is just what the fair value or the value of the business is. And the book goes into full detail explaining how to do this calculation. I'm not going to go into it again. Plenty of detail in the book. It would take too long for me to do it here. But once you get that answer, like I mentioned earlier, now you're going to find your margin of safety, which is just cut that sticker price in half. And the reason we do this is because investing is not an exact science, and valuation of a business is certainly not an exact science. So we could be wrong. And, even the smartest people on Wall Street are wrong all the time. So cutting it in half gives us a lot of margin of safety in the event that we are wrong. And if we are wrong and we've got a 50% margin of safety, we still might end up making money. Now that you got the price of what the business or the stock is actually worth, you're going to wait for it to go on sale. Once it goes on sale, you're going to buy it up and hold it for the long term. The book recommends that you buy the stock for the long term, which the way he explains it would be 10 years. But he also says that once the stock hits the price that you determine is the fair value of the business, so if it's the fair value is the sticker price is $100 and you bought it for $50, once it hits $100, you're going to sell it. And then you're going to take those profits and you're going to put them into another rule number 1 business. The reason why he recommends with rule number 1 investing is once you've hit what you believe the stock price is actually worth, sell it because it could drop and not go back up again. Again, this rule number 1 strategy is all about rule number 1, not losing money. That's why you've got a 50% margin of safety. Could you buy a stock with a 20% margin of safety, 30%? Absolutely, but that's just more chance of you losing money if you're wrong. Same thing with selling the stock when it hits the fair value, when it hits the sticker price. Could you hold it and could it double or triple in value over the long term? Absolutely, but it also could drop and never recover again. So you got to think about some of this stuff through the lens of this particular strategy. This isn't the only way to invest, but I do think that this is a really excellent way to invest and do it fairly safely. That's not to say it's not without risk, but all of the rules that Rule Run lays out in picking companies really helps to minimize that because you're buying big, consistent companies at a deeply, deeply discounted price. I hope this video gives you a good idea on how to start investing in individual stocks, or at the very least, a strategy that you can pursue further. I know, like I said, I fully intend on implementing this fully in a part of my portfolio. I'm going to make videos updating you on kind of the process, how I decided what stocks I picked, what price I bought them at, and how they perform over time. Do me a favor and let me know what your investing strategy is in the comments down below, and I'll see you next time. Thanks.